So the big question is this: how are those in the self-storage industry like us going to be successful in today's market? That's the question, and this show will give you the answers. My name is Jim Ross, and welcome to the Self-Storage Show.
Hi everyone, it's going to be a great session for all your self-storage owners, looking to build, renovate, refinance, acquire, have it all. Happy to introduce you to Terry Campbell. He's part of the team at Live Oak Bank. Terry's got ton of experience in the self-storage industry. He's got a great presentation on self-storage financing. Anyway, thanks Terry. Thanks for joining me. How's it going?
Great, and thanks for having me, Jim. I really appreciate it.
Yeah, this is fun. So I'm glad you are able to. I know you're slammed and busy, so I'm glad you're able to take some time and give a little presentation for everyone that's joining us here for the summit. So anyway, before we kind of get started with this, rather me kind of blab on, tell me a little bit about yourself, kind of background.
Super, I sure will. Well, as far as the self-storage industry, I've been in the self-storage industry right at 25 years, actually. My first 20 years in the industry was with a self-storage building manufacturer, and I kind of started out there as a drafter and an estimator, and by the time I left, I'd actually sort of worked my way up and learned the industry, learned the business, and I was executive VP of operations and also VP of sales and marketing by the time I left, before I came here to the bank, and started here at the bank in early 15, so I've been here a little over 4.5 years. I've been a part of a lot of seminars like what you're doing here. These are great. These are great to reach the masses with a lot of information. I love to share information and my experiences, and this is a great way to do it. Written articles for the magazines, spoken at trade shows, just done a lot of things. In fact, I was one of the original folks that helped start the North Carolina Self-Storage Association, and still on the board there. And in fact, I'm the convention chair. As if I didn't have enough to do already, I'm on the convention committee and the convention chair for our show this year, which will be in October in Charlotte.
Or why not?
Yeah, and I want to, since I mentioned the state association, I want to take a minute and just mention this for those watching this who are not members of their state association, that most every state has an association. I think it's very important that you be part of that association and that you play an active part, because state associations are great when they're operated correctly. It's great for the industry and great for the folks. You can get, for example, with our association, if you're a member, and it's just it's like a couple $100. If you're a member, you can get a rental agreement that's been written by a self-storage specific attorney, which is invaluable. It's going to cost you a lot more than that if you just go out and hire an attorney to write one for your state. They can be advocates for you with the government for legislation, maybe trying to add sales tax to your rentals or late fee controls and things like that. They're great to have. They're great to be a part of. I recommend that if you're not a member or you're just getting into the business, that you check it out and see if your state has one, and find out what you need to do to be a member, because they're great organizations, and I think they're very important to our industry.
I always tell everybody, you kind of get out of it what you put into it on those kind of things. You got to be part of it, be active into it. So, yep. No, that's great.
Exactly.
So, kind of talking about I know you're crazy busy. So, what's the lending activity been like lately for you? I know you're going nuts. So, give me a little insight.
Well, it's still busy. It's still very busy. Back when I started here at the bank, when we started this vertical, the self-storage lending vertical, it was right after the Great Recession, and there was a lot of pent-up demand at that point during the recession. Nothing got built because people couldn't get money, and when money started becoming available, that huge pent-up demand had it exploded the industry and the growth that was going on in the industry. And there's still a ton of interest. I would say we've mostly, if not totally, caught up with that pent-up demand. that was out there. I think we've got that filled now, and that we're back to normal growth. But normal growth is, I think, changed. That there's more population. There's a higher percentage of the population that's using self-storage. So there's still a ton of folks that want to get into the business, that are interested to get in the business. And, there have been times it almost seems like there's a panic for folks to get into the self-storage business. But we're still busy. We're still seeing a lot of things. Not as many deals are working as they were for various reasons. Interest rates went up for a while, materials went up, just different things that have caused the actual process not to happen, but the interest is still there, and there's still a ton of people looking to get in the industry. So we talk to a lot of folks all the time.
Yep, that's kind of why we're doing this summit, because again, it's one of those things that
Exactly.
there's much value in getting the information out to people, because I see the same thing. People are kind of feeling like they need to get in before they miss the boat, kind of a thing. You feel that. So as far as like what you guys are doing for loans and that, you kind of seen it more for like acquisitions, or more for rebuilding or buying new? How's that looking at you for you?
Well, what we're seeing is the same thing we've seen since we opened shop here to do this for self-storage, which is new construction. Still 80+% of everything we see and lend on is new construction.
Really?
We are seeing a little more acquisitions. We've done several acquisitions over the years. I mean, we've done over $500 million in self-storage lending since we started this team 4.5 years ago.
I know.
It's crazy. But it's mostly still new construction, some acquisitions, a lot of conversions. I still lump that in with new construction, but we're seeing more and more conversions. I personally love conversions. There's a lot of reasons. There's if you've got a good building, you really don't have much, if any, construction risk.
You can do it quick too. Yep.
Yeah, you're not going to be delayed by the weather. There's just all sorts of reasons conversions make sense. We occasionally do, a finance or refinance. I think we're seeing more of those as well. But we're pretty much anything, even rehabs.
Yeah, just in my own little world, that's what I keep seeing is more of the conversion type of things. That's why I asked. I was kind of curious what you're seeing on your end. You see it all over the country. I mean, you are nationwide, right? You're all over.
Oh yeah, we're in all 50 states and U.S. territories.
Yep, no, that's fantastic. So just curious right now with where we're at in the climate right now, as far as like interest rates and things like that. What are you seeing like now in the last couple of years? How has that affected the loans?
Well, we've had some interest. Everybody knows we've had some interest rates the last couple of years. Starting in 2017, we had 2 interest rate increases. We had 3 in 2018, and then we had 1 at the beginning of this year. Although we've had 1 decrease this year that offset that. So, and they're expecting probably next month to have another reduction in interest rates. And the thing about them, all of these interest rate changes were just 25 basis points or 0.25%. So it wasn't anything major. It was a little at a time, and they really haven't affected the appetite out there for folks. I mean, they haven't changed enough to affect the appetite for folks who are wanting to build. So as far as that's concerned, it's not really slowed them down. It has affected, it does, make them take a second glance, and it has affected the way that they look at things or the products that they may want. Back before the rates started, most everything we did actually was floating interest rates. And once the interest rates started going up, everybody wanted fixed rates. Yep. Now that, and we were doing fixed rates for a while, we've been doing those, we're still doing those. But now that there's been some decrease, and possible further decreases to come, more people are interested again in the floating rate, because they're thinking, okay, my rate's going to go down. If I fix it, it's going to be where it is. So it's affected that thought process a little bit as well with folks.
Huh. That's interesting. So what kind of size loans do you guys do? You have like certain caps you have to work around, or what kind of size loans are you dealing with?
Well, the sizes, as a rule, here, what we typically do is a minimum of around 350,000, and we usually go up to around 10 million. So that's sort of our rule of thumb, but we do have some programs in different ways that we can go higher than the 10 million, different loans and sometimes participation by other banks, we can actually go higher than that. So, but that's sort of our rule of thumb in the loans we do. And I'll get into some more details later on some of the different caps and so forth.
Gotcha. So maybe that kind of leads into like, well, what kind of loans do you guys do? What other different types of loans are there?
Okay, SBA loans is the majority of what we do. We've always been known as an SBA bank. That's how we started. That's where we started out back in 2008 as an SBA lender. And that's what we do. We're actually the largest SBA lender in the country by dollar volume out there that exists. Because we've really grown the last several years. And but SBA is what we've always been known for. People still to this day think Live Oak, oh, that's an SBA loan. Yeah, but we've grown. We're growing up. We're becoming more than just an SBA lender. We also can do USDA loans. We've done some of those in our self-storage division. We actually have a USDA team here that specializes in USDA. We also have started wading into the pool of conventional lending. We can do conventional lending in certain circumstances, certain loans, certain borrowers. So we've just started doing that. We've got a couple we've done. We're looking, at more and more of those. Like I said, we're growing as a bank. We like to say we're growing up. Instead of just being an SBA lender, we're being a real lender that can offer a lot of resources. And by offering a lot of resources and specializing in a certain industry, that can make a world of difference for that borrower. And that's the way the bank was designed.
Well, that's perfect. It kind of leads to my next question. So, I mean, you provide these kind of different packages for people, and for the bank, obviously, work with them. I'm the borrower. Like, what am I? Yeah, I've never had the privilege of owning a storage site, so I don't know. I'm green to this, but like if I was a borrower and going to the bank, what are they requiring? What do they have to bring to the bank to get the loan going?
Okay, as a borrower, what you need to provide as far as documentation is going to be personal tax returns, business tax returns. If you own a business already, we're going to want to see the personal and the business. And also interims on your business. If you're purchasing a business, if you're doing an acquisition, we're going to want to see tax returns on that. Typically, it's 3 years on all of these. We want to see tax returns on the existing business too, to be able to lend on that. And some folks who own self-storage, they sort of shoot themselves in the foot because a lot of people in the past have operated by keeping the cash and putting it in their pockets and not reporting it. So if you don't report that income and it's not in your tax returns, the value of your facility is going to be on what your tax returns were, what you reported. So the value of your facility is not going to be as high because you didn't account for all the income. And sometimes we see issues with that. But tax returns is one issue. Interims, personal financial statements is something else we're going to want to see on all of the borrowers, all the guarantors who are going to be guaranteeing the loan. Business plan, I want to see a resume on the borrowers. And if it's a new construction, we want to see a feasibility study. In fact, we will not do a project without a feasibility study. And if it's a really small loan, a really small project and something you could cash flow out of your global cash flow, you could pay it out of your pocket, even if you didn't make a dime on it, we might consider the loan. But you should have a feasibility study. There are lenders out there that say you don't need a feasibility study or we don't require a feasibility study. That is one of the most irresponsible things anybody could say to a potential self-storage owner.
Yep.
It's irresponsible because that study is going to tell you, and you know all about this, Jim, but that study is going to tell you about, should I build it? How much should I build? What type of storage? Climate control, boat and RV, just non-climate. What should it be? How fast am I going to lease out? What should my rents be? It's going to tell you all this information you really need to know, and it's something we require because if you're not willing to spend a few $1,000s on something that's insurance that's going to help you make this decision wisely, and you're willing to borrow a couple of million and not spend a few thousand, that's not wise, and that's not really somebody that we want to do business with, if that's really the way you think and that's the way you do business. But the feasibility study is very important. Management reports and rent roll if you're doing an acquisition. We're going to want to see those as well. Now, I mentioned, you heard me say business plan.
Yeah.
I'd like to take just a second to elaborate just a little bit. You're not going to have the luxury as a borrower to be able to go and speak to the credit officer or stand before the credit committee and talk about your project and give them the confidence and tell them, you know, you're not going to be able to communicate that because you're not going to be there. The only way you're going to do it is through your business plan, by writing a business plan that's strong, that tells you exactly what you're going to do, what's going to happen. If it doesn't happen, what's plan B? How are you going to take care? I mean, that business plan should spell out everything. It should talk about yourself as well, how you're going to run it, and look as professional as possible. Look at it as if you're going to loan the money to someone and you're reading that business plan. Do I feel confident in this business and in this person? So take some time, build that business plan, and make it look really, really good before you send it in. It makes it a lot easier on your lender you're going to be working with, who is basically your conduit to the credit department and the credit committee. So that's really going to stand out, and it's going to make you look good, and it's going to help give the confidence for you to get a yes vote for that loan.
So I'm just kind of curious, you know, I'm looking through all these things, you know, this process and getting everything put together, presented, and all that kind of stuff. What do you kind of see as far as like a normal timeline on how long it normally takes to get a loan?
The timeline. This is, I always say this depends on the borrower.
Okay.
You know, I like to tell folks whenever we start working together that they're now part of the lending team. They're part of the lending team, the closing team, they're part of the team, because we can only move as fast as the borrower will allow us to move. And when I say that, we're going to ask for documents. We're going to ask for information for us to be able to take it in, look at it, do a review, look at your cash flow, look at the background, look at everything we need to know. And the longer it takes to collect this, the longer it's going to take to get it done. Now, if we got somebody that's playing by the rules and getting us everything as quickly as they can, like immediately, we've closed loans in 30 to 45 days before. Which is, that's quick. And, you know, all the planets had to be aligned. I think we already had an appraisal that we were able to be reassigned to us. That's not typical because it's just not. But as a rule of thumb, we say 90 days, just so there's not any real surprises, because, you know, we got to get all the information from the borrower. We got to get through approval. We got to get third-party reports such as environmentals. We got to get appraisals and that sort of thing. That it's out of our hands. It's out of all of our hands. But the faster that the borrower gets us information, the faster that we can make this happen and get it done. So, like I said, I always say, now you're on the lending team, you're on the closing team. Now you got to play your part to help us get this done as quickly as possible.
Let me help you. Yes.
Exactly.
Boils down to.
Exactly.
So, I mean, you've seen everything, obviously, from the good, bad, and the ugly. Is there kind of a loan that looks, you know, like you would say that this is a good loan?
Well, what we would consider a good loan is, first of all, starts with a good borrower. A good borrower is going to have good credit history, good character. I'll get into that in a minute too, but it's going to start with a good borrower. It should be an opportunity that makes sense financially, has a great plan that should be very profitable, and it's going to cover the debt and expenses. That's what a good loan is going to look like. And to step on over into that, you know, what's a good borrower? That is a main key there. A good borrower is going to have good credit history, good character. One of the things, you know, in talking with our special assets group is who handles deals when they go bad or start getting sticky or looking like there may be a problem. According to them, the biggest number one issue with loans going bad is typically the character of the borrower. It just says a lot. So we put a lot of emphasis on that. We call it the eye of the tiger. We want to know, you know, that's why we meet with every person. We meet with every borrower face to face. We go to every job site. We go and look at every location. This is
There
an
you go.
existing
You told me
facility.
before, you're flying all over the place and you're physically there.
Yeah,
Yeah, that's awesome.
exactly. Exactly. And I mean, we get up on the, if it's an acquisition, we get up on the roof. You know, I put my 20 plus years of construction background to use, and we look at the roof. What kind of roof do you have? Are there any issues? We look at the doors, we look at the springs, are there tension adjusters? We look at the drainage, we look at everything about that site, and we add value there. By doing that, we've actually saved folks a lot of money on their purchase price. And sometimes they just didn't buy the facility because they didn't realize what they were about to buy. So that's a value add service that doesn't cost anything that we provide for our customers. And we want to do that for everybody's sake. We don't want to just make a loan. That's something I want to just throw out here is that we don't, as lenders, we're an anomaly in the banking world. Our lenders do not make a commission.
Mm-hmm.
I'm not saying that the rest of the banking world are bad guys because they do make a commission. It's just the way this establishment was set up, was that Live Oak Bank, nobody here makes a commission. That way we're all pulling for the same goal. And you don't tend to pull for yourself and try to make a deal that shouldn't really go through. You know, you don't want to try, you're not going to be tempted to put a square peg in a round hole because you need commissions to make to buy Christmas presents, that sort of thing. And we all, you know, benefit whenever we do well as a company and we share in the profit. So that's how we make our money, is by doing the best we can for the borrowers, the best we can for the bank. And that way everybody's in good shape because, you know, we don't want to put anybody in a bad spot. We don't want to put them in a loan they shouldn't have because, you know, someone were to end up defaulting on their loan, okay, you know, we're gonna deal with it here, and but we're gonna go to bed and go to sleep, and you know, we're gonna be fine. But that borrower is going to be in a bad place for a long time. They may have to declare bankruptcy. They're not going to sleep well for a long time. It's going to ruin their life for a while. We try to prevent that. We don't try to make every deal happen that comes across our desk. If it should happen, we try to make every deal happen, but if it shouldn't, we won't let it happen because it's not just the borrower and the bank.
Mm-hmm.
For me, it's about protecting the industry. So it goes a little further than just that. I mean, the industry is very important to me. If it weren't for self-storage, I wouldn't be worth much because, you know, this is all I do. Self-storage is all I do. I own self-storage. So I want to protect the industry. My team wants to protect the industry as well. Let's see, some of the, like I said, not everyone's going to qualify for a loan, and even people that you would think would. Sometimes you get deals that maybe somebody just bought one and they haven't developed enough track record yet and they want to buy another one. Well, I just bought this one over here. I don't know why you can't give me a loan. Well, you just increased your debt and you don't have a good track record of performance or the performance of the facility. So we got to give it some time, let it season, and then let's look at it.
Yep.
So, you know, like I said, everybody's not going to get it.
Wow. This is why I love talking to you, because you always have you guys in the Live Oak Bank, and that is you have the customer in mind the entire time. Like you said, you're not trying to fit makes a project work, you know, for these kind of selfish needs in that. So it's kind of funny that things work out when you have the customer's benefit in mind the entire time. Things tend to work out, you know, in the long run.
Exactly.
So,
the mantra here, the CEO's favorite saying, and it's on a lot of things around here. In fact, it's on the parking garage where we pull in every day. So you see it first thing. It said, treat every customer like the only customer. And that's the way that, you know, we try to do.
No, that's fantastic. It comes through. Kind of going back to what we were talking about before about the different kind of loans that you have, but I know you guys specialize in the SBA program. So I thought you may kind of elaborate a bit more on that.
Sure. Like I said, we are the largest SBA lender by dollar volume right now, and we have been for a while. But the two SBA programs that are out there are the 7A and the 504. Okay. A little bit about the 7A is that's where we've done the majority of our work is in the 7A program. Most of that, over $500 million worth of loans has been done in 7A, and there's reasons for that. A little bit about the 7A is that it's only 10% equity requirement. That's the minimum. At one point, there was no minimum equity by the SBA. Now, we've always required 10% because we feel like you need to have some skin in the game, and it's going to help make sure that you're not over leveraged. But there's a 10% minimum. equity requirement, so we could finance up to 90% of your total cost of your project, which also can include working capital and lease-up costs and interest-only payments during lease-up. So in theory, we could do a new construction with only 10% of that cost that you bring to the table, and we could include enough working capital and interest only to get you through a point where you break even till the facility starts paying for itself in full. So in theory, that's what could happen, and that's what we try to do for folks who want to do that. It's a 25-year term. It can be fixed or it can be variable. I think I mentioned a minute ago how that's been working. You know, most of them were variable. Then we were doing a lot of fixed, and now people are talking variable again because interest rates are starting to fall. If you're a guarantor for that loan, anybody who's 20% or more guarantor will be a guarantor if you're 20% or more owner. So with a guarantor, the requirements are the SBA says you got to have a good credit score. You know, and it depends on who you ask as to what a good credit score is. If you ask a guy with 450, he's going to say 450 is, but we consider, and the bank sets that. So we consider 650 a fairly good range. So we look for a minimum 650 or better credit score. You got to be a U.S. citizen. You can't have defaulted on any other government loans. You can't be on probation or parole. And actually, the way the SOP reads, you can't be incarcerated either. Haven't had anybody in prison that I know of that's applied for a loan yet, but you never know since we're online. For us, you can't have had any bankruptcy. I mean, it's a pretty hard rule of thumb. There may be the occasional exception. But if you've had a bankruptcy, we can't do it. So usually if we have folks that have had a bankruptcy, they need to bring in partners to help get that loan done. Because what we've experienced is once you've had one, there's a very high propensity to do it again, regardless of the situation. Again, there's the outliers where we've worked with some, and we have to have a really strong look at that. We have a really strong look with credit at that as well. But that's the majority of the high and low points of the SBA 7A loan. But again, the big thing with the 7A is they're great for construction because we can build in that working capital and interest only payments while you lease up, because you know the lease up is one of the most dangerous times. Everybody's having a great time during construction, watching the building go up. You see progress, things that are happening, and you really get into it and you like it. But reality sets in the day you get the CO and they hand you the keys. I got an empty building here with X number of units that are just sitting there empty. I got to get them full. So between that day and the day you break even, how do you cover that? And that's one of the things the 7A can really help with. Now the 504 is it's a good program as well. The thing about a 504 that's different, now let me back up just a second. With the 7A, that is the bank's money. That is not SBA money. The bank is going to guarantee up to 75% of any loss that the bank may have as a result from a default. So that's one of the big differences. With the 504 program, the bank is actually going to provide 50% of the cost of the loan. Then the SBA is going to cover 30 to 40% of the loan, and the borrower is going to cover between 10 and 20. Usually, most of the time, a 504 is going to require 15%. The only time you can usually get away with only 10% equity is if it's an expansion of an existing business that's been in business for at least 2 years. So most of them are going to fall in the 15% range, and sometimes they're going to fall in 20%. There's the CDC. There's a CDC as a certified development company, is sort of a liaison between us and the SBA. So it has to go through the bank, through the CDC, and the SBA for approval. So you've got all of these, and your CDCs vary. There are several of them across the country. Most of them only do business in certain states. So there's not like one national CDC that you can use for all states. So each one has their own interpretation of things and what they're willing to do. So what you may be able to do in one state, you can't do in another. We've even had one state that actually said the CDCs in that state said, sorry, no self-storage, we're not going to do it. which is unusual and it's different. We've not run into anybody else that has said that, but we have to engage that CDC, get them up to speed on the deal, get it to them once we've approved it, let them approve it, and they get it to the SBA for approval. So it can be a little longer and a little hairier process. But the good thing about it for the SBA 504 is that the SBA's portion, which again can be 30 to 40% of that loan, typically it's going to be about 35%, that is going to be fixed. It's going to be fixed for the life of the loan, and you can get a 20 or 25-year term. So you could get a 25-year fixed term today, right now, the day we're talking, in September, what is this, September the 17th of 2019, the fixed rates for that portion of the loan is like 3.4 something percent, less than 3.5%, and that'll be fixed for the life of the loan. Now the interest from the bank is going to be whatever they set it at, and then you're going to get a blended rate, which, you know, it's good. This is a good deal. If you can do that. Now for construction, if it's a big deal, you're not going to be able to include working capital or interest only payments, so you're going to have to be able to feed that out of your pocket. There are some other ways to do it using a 7A, but it depends on the size of your loan. I won't get into those details. Somebody, you know, gets to the point they want to talk about that, we can do that as well later. But the big thing between those two is the working capital and interest only you can't include. Plus with the 7A, there's a 3-year prepayment penalty. With a 504, there's a 10-year prepayment penalty, which is on the debenture, which is the part the SBA provides. So that's another one of the differences as well. But they both have their place. They're both good products, and we've been doing several more 504s lately that we had not done in the past, mostly because of those rates the way they are now.
I bet. Again, you're keeping busy. You got so much going on. It's nuts. Anyway, it's just kind of, let's wrap this up here. But I figure, again, with all the experience, and I mean, you guys know this inside and out. It's what you do day in and day out. I don't know, toot your own horn for a little bit. Kind of give us a little more of the advantage of people working with Live Oak Bank.
Well, I mean, when somebody says, is there an advantage to working with your bank? You know, every bank's going to say yes to that question. But when you look at the way that we specialize in different industries, we specialize in the SBA. If it's an SBA loan, this is what puts a distance between us and other banks. Like I said, you know, I mentioned a minute ago that there have been projects where we go out and do the site visits. I don't know of any other bank that does that. I don't care where it is. We go out and do the site visits. We visit, we look at them, we bring value to these customers by bringing our experience in. You know, my experience in construction background and as an owner gives a whole different perspective than just a lender who doesn't, you know, one of the projects that we went out and visited, had that borrower not went with us, he would have made a huge mistake, and right now he would be in big financial trouble. I want to get into the details, but we actually saved him, and we've done that on a couple of deals. We've been able to go on site visits where I remember going to one in just across the line in Georgia, north of Florida, where they had a lot of, I saw it on the rent roll, that they had a lot of empty 5x10s. And this project was built years ago whenever people like to do a banker's mix, you know, where a banker's mix is a lot of small units because small units bring more revenue per square foot. And these folks had put in a lot of 5x10s, but there was no market for them. And it was a block building too. So during my visit, I went in and looked, and I could tell, okay, this is a load-bearing wall. This is not. This column is load-bearing. This is not. Take these walls and columns out. Take these small doors out. Put a big door in. Now you have a 10x10. They were able to do that and leased them up. So, you know, things like that is really where we bring value. Our team has gotten very, very good at the industry. They go out and do these things, you know, without me as well. I mean, I had the construction background, but these guys, we've done it together a lot. Yeah. And they know what to look for as well. But our team focuses only on self-storage all day, every day. And when you do that, you learn things on every deal that you can help the next customer with. So there's just, you know, there's more than this. We can offer different perspectives than other banks just because of our experience and our day-to-day involvement in the industry.
Well, that's fantastic. And again, that's why I reached out to you specifically. I want to make sure I had you come on this summit because, again, it's what you guys do day in and day out. So that's
Exactly.
that brings a lot to the table. So I appreciate that. Well, again, thanks for, and again, I know you're so busy, but thanks for squeezing me in and doing this. We'll have all your contact information right here on somewhere on the speaker page. Reach out to Terry. Any questions, comments, in business form, yeah, reach out to Terry. So again, thanks so much.
Thank you, Jim. I really appreciate the opportunity. I'm honored you asked me, and I appreciate the opportunity to be on here and give a little information that hopefully will be helpful for your viewers.
Yep, you'll bring a lot of value. Thanks a lot. See ya.
Thanks, Jim. All right, bye-bye.
I hope you enjoyed today's virtual summit highlight. If you want to watch the rest of all of the amazing presentations from this summit, then go to the virtualselfstoragenetwork.com to register to attend for free.